Martin, thank you very much for joining us. My name is David Clayton. I'm a trustee at the IPPR and an acknowledged fan of Martin's columns and brilliant writing. I think it's a fantastic time, mostly because Martin will have been around the world a dozen times talking about this book, and I expect all of the interesting questions have been asked, so hopefully we'll be able to find some new ones for you. I thought we would start, maybe, Martin, with your slides and comments, and then I've got a couple of questions for you. We'll open it up for what will hopefully be a broader discussion.
Yes, let me just put this off so I don't get a call during the middle of it. So, I've been told somebody is going to manipulate the screen. I have only got some pictures up, so not. It's a pleasure to be here. I am getting sort of to the end of the active promotion of this book, but not quite. I've got one event tomorrow, but I think that might be the last this year. And next year, it's, as far as I can see, it's just literary festivals, which should be a very different experience, and not one I'm at all familiar with. I've never done literary festivals before, but I imagine most of the people there are interested in literature and won't consider this book falls into that category. Not enough fiction. But I have done a great many events, and it is true that some of what I have to say I have said before. I'm going to talk for, I suspect, about 40 minutes, 35, 40 minutes about the sort of overarching themes of this book. And then So the shifts and the shocks, it's an analysis of the crisis we have been and are still in. It's definitely not over, certainly not. And both in terms of how it originated and what I think some of the lessons are for future policymakers. It's quite a wide-ranging discussion, which, though, you know, at one stage I thought I should go back over several centuries of financial crises, but others have done that, and I didn't want to do that. So it focuses very much on the events that began in 2007 and have continued since then on both sides of the Atlantic. It's global in orientation. It looks at both macroeconomics and finance and tries to link these two, macroeconomics and finance, together. That might seem pretty obvious to you, but by and large, with very, very, very few exceptions, economists have not been doing that at all over the last 60, 70 years. In fact, it almost originates with Keynes himself. One of the interesting things about the General Theory, which is, of course, the most important book on macroeconomics ever written, there isn't any doubt about that, created the field effectively, is that it has essentially no financial sector in it at all. And though Keynes was himself, of course, an expert and was very interested in it, a lot of it is in previous books of his, but he started off doing macro without finance, and that tradition continued with people who agreed with him and people who utterly disagree with him. Finance disappeared. And the only exception that matters was Hyman Minsky on the post-Keynesians, who has influenced me immensely, but only recently. I wasn't familiar with his work before writing this book really well, not as well as I should have been. Intriguingly, the Austrians, who actually turn out to agree with Minsky more than either do with any other school. It's slightly peculiar. I'm not going to go into that chapter, but I have a chapter discussing ideas on macroeconomics and the different schools and how they interact and what you might learn from them. And that was one of the chapters I most enjoyed doing. I don't regard it as definitive, but it's quite brief. And I think those who aren't into economics analysis might find it at least stimulates them. So what I'm going to do is divide my remarks. The first is what happened and why, what I call the shifts and the shocks, the shifts in the economies, the underlying driving shifts, and the shocks that resulted. And the second part will deal with solutions, what is being done and what is left open and what should be done. So let me start then with what happened. Well, I don't think in this audience I have much difficulty in persuading you. Actually, I've had remarkably little pushback on this remark, which I'm going to make in any of the presentations I've made, which is what happened was a tremendous failure of both policy-making institutions and underlying economic understanding. It was and remains an enormous policy disaster. And if you don't start from that point, then I don't think we're going to get very far in analyzing its implications. It should be said, and I'll come to that later, that the policy establishment, of which I suppose indirectly I'm a part, but I consider myself slightly separate from them, have basically behaved as if this were not true. And I think that's one of the most important implications of where we are now, that the policy establishment is behaving as if this wasn't such a colossal disaster. In my book, I define the policy system we had before the crisis as the old orthodoxy, or the pre-crisis orthodoxy, to distinguish from the new orthodoxy, which I'm going to describe in a moment. And the old orthodoxy was really terribly simple. I won't go into the intellectual history of it. It's long, and it's evolved over a century or more. But in essence, it was that the challenge of financial stability will be delivered. Sorry, the challenge of macroeconomic stability would be delivered by an inflation-targeting central bank. For previous monetary anchors, of which the most important in the past century have been either exchange rate targets or monetary targets. And of course, the uber combination of exchange rate targets and monetary targets, the gold standard, that was where we started. And we had inflation targeting by central banks, which has became the dominant orthodoxy in all Western economies. We can discuss the differences, but essentially the same. And financial deregulation, along with other forms of market deregulation, would generate a rising prosperity and, in some sense, for all. We would generate, in other words, stable prosperity. And obviously, given the scale of the crisis, this turned out not to be the case. And that has meant, in my not just a huge economic shock, which I'm going to come to in a moment, but it's also a shock to our thinking about the economy, the way we think about the economy. And I regard it as the second huge shock to the way we think about the economy as a whole, macroeconomics, with the field that Keynes essentially invented in the 30s, macroeconomics. The first huge shock after the acceptance of the Keynesian revolution during the course of the Second World War, that's basically when it happened, was the great inflation of the late 60s and 70s, which led to the abandonment of Keynesianism as conducted in the 50s and 60s and its replacement with monetarism and then inflation targeting. And my view, very importantly, is that economists have not responded adequately to the scale of this intellectual disaster. Now, just to indicate this, by the way, I should tell you that I'm quite deliberately not focusing on the UK. I'm very happy to take questions, but I want to stress this is a global crisis. So I'm focusing on big economies. We're not a big economy. And I think looking at what the world as a whole has done is very interesting. But I will make a few comments on the UK as I go along. So this is a chart which comes from the book, more or less. I think it's slightly updated here, of what the crisis has meant for the world's biggest economy, the US. So this is a chart of US GDP, which goes back to 1950. That's the red line. I fitted an exponential curve because this is a long period and growth has been quite constant. The curve slopes upwards, as you'd expect an exponential curve to do. I think the growth rate was about 3% a year, something like that. I could give you the exact figure. And as you can see, this blue line fitted US GDP pretty well over nearly 60 years. It's a very long period, right? And then the crisis hit, and this is where US GDP was. I think this was in the early 2014. So it's pretty clear that it's in a completely different place. And to show this, my green line shows deviations, and you can read on the right scale, deviations from trend over the trend, so proportional deviations from the trend. And you can see that over this long period, it's gone up, zero is here. So it's gone up above it. The 60s were particularly dynamic. So in the 60s, the US was above trend. It was above trend in the late 90s. We know there was a boom period in the late 90s, you know that. But anyway, today, the US economy, or the most recently, is basically 18% below trend. In other words, the US economy is almost a fifth smaller than people actually did expect it to be back even in 2006 and 7, when they were just simply assuming it would go on like this because it had for 60 years, right? So it's now a fifth smaller. I will tell you now, that's one of the reasons I didn't put it. The UK curve looks exactly like this. And we're also very close to a fifth smaller. Our GDP is almost a fifth smaller than it would have been if it had continued this trend. In this case, because quarterly GDP in the UK wasn't computed since before 55, my trend is from 55 to 2007. And it's very, very similar in shape. It's like how constant this was. If we move to the next chart, this is the same thing done for the Eurozone. The Eurozone GDP figures are not computed before 95, and I didn't have the time to go back and add all the economies together. So it just starts with 95. As a result, exponential curve doesn't look very bendy. It's bending up very slightly. Eurozone GDP, as you can see, was not very dynamic before the crisis. We know that. It was been growing at less than 2% a year. We were the fastest growing big European economy before the crisis, over about 20 years, actually. And then they hit the crisis, and this is what's happened to Eurozone aggregate GDP since the crisis. And you will reach the conclusion, if you look at that it stopped growing. And that's basically right. It stopped growing. The Eurozone is no longer a growing economy. I'm not saying it never will be again. I assume it will be at some point. But in essence, the Eurozone, just keep it there. The Eurozone economy has remained flat now for 7, 8 years. This is very abnormal. Such very long periods of stagnation are really, really rare in the history of modern economies. I won't go back into the 20s, 30s. The UK did have this in the interwar period, a very long period, which I'm going to come to in a moment. And the Eurozone GDP, because it was much less dynamic, is now, and this is the second largest economy in the world, is about 14% below trend. So the conclusion you can reach is the losses have been enormous relative to pre-crisis trend, and these trends were long-serving. Stanley, if we can go on to the next chart, I thought I'd put this in because it's fun than anything else. It's not incredibly important, but it is the penultimate chart in the book. And here I wanted to do something about the UK. So this is UK GDP per head, as estimated by Angus Maddison and updated to the very latest year by the figures of the Conference Board, which actually come from the OECD. And the red line is UK GDP per head going back to 1870. And unlike the US, I've done exactly the same thing for the US, which has actually constant growth rate throughout this period, which is quite remarkable. We seem to have two growth trends, and we're now somewhere else. That's what's so interesting. This is up to the end of 2013, by the way. These are annual data, so we don't have 2014 yet. So we had a really rather low growth rate which fitted very well from 1870 through the Great Depression up to about 1950, sort of about here. This growth rate in GDP per head is a little over 1% a year. In the post-war period, we have been in somewhere completely different. This is the fastest period of growth, this whole post-war period in British economic history, much more dynamic than the 19th century. And when Mr. Macmillan, I was thinking about this when I looked at it, said about here that you've never had it so good after this growth rate in the 50s, he was correct. There was something really changed. We've had some big recessions in the 80s and in the early 90s, and then a very long boom. We're just discussing this very, very long boom. But essentially, we stuck on this trend of GDP per head since the war of about 2% a year. That was over 60 years, that's a big deal. 2% a year, a bit more over 60 years is a big deal. And this is what has happened since. And it's pretty obvious we're somewhere else. Now, we're now growing on GDP per head terms, still well below this, because in case you haven't noticed, most of the growth recently has been in employment, not in GDP per head. Underlying trend up productivity, but we'll probably be about here now, 2014. So we're all in somewhere else. Let's go on to the next chart. So the obvious question is, why on earth did this happen? Why have we moved somewhere else in this way? And I'm arguing in my book, and I will discuss a little bit more why it happened, is there were some very large macroeconomic changes, what's sometimes called the savings glut, which is both external and internal shifts in income towards very high savers, externally through the global balance of payments, internally through shifts from wages to profits and shifts among wages towards very high earners. So a whole range of changes in the world economy whose effect was to shift income massively from from spenders to savers in a very simple way. That triggered a fall in real interest rates, which was very marked in the late 90s. And that triggered rises in real asset prices and global imbalances, which were linked in complex ways, which I won't have time to discuss. Those created the prior conditions for the trigger events in Minsky's word. I think he used displacement events in his terminology for the credit booms. And the second thing is, when those things happened, and this chart discusses that, we had a very rapid rises in real house prices, and this allowed a very rapid growth in credit associated with the rising value of this collateral. House prices are the most important collateral for borrowing in our economies. Most borrowing is secured against property, commercial property and houses. So when their values rise, this encourages people to borrow a lot more, and it encourages people to banks to lend more, and that pushes up prices further. So that's how the credit bubble element works. And of course, the financial innovation and liberalization of the 2000s and late 90s and 2000s facilitated that process. So that's, in brief, very brief, the whole story I'm telling, the interaction between these macroeconomic shifts in incomes with a liberalized financial sector. This is, I think, probably the most important, if perhaps the most abstract chart I have in my book, but it shows this story in a very simple way. I've used as my proxy for the world's real interest rate on safe assets, the sort of benchmark real interest rate, UK gilts, 10-year index-linked gilts. The UK has been supplying index-linked gilts for a very long time. It's a liquid market. Other developed countries have got there, but later. So if you put in the US TIPS, they're called, inflation protect, what are they called? Treasury inflation protection securities. And you basically got their data from about 2003. They track almost perfectly, as you'd expect. The global real interest rate on safe assets should be pretty similar, and they are. And what's interesting about this is we've gone in that period, which I described, through two periods. The first was about the time of the Asian financial crisis, when the real interest rate, which is shown here, fell from 4% to about 2%. This is a really big deal. A halving of the interest rate in such a short period is a very big change, and it never reversed. And that's why I think the Asian financial crisis is a central event in the story of the global economy, and I won't have the time to discuss why that happened and why it had these implications. It's my view. We ran with 2% real interest rates in a period of relatively rapid growth up till 2007, and then we got to the second stage when the world economy collapsed, and this goes up to 2013, been in a zero real interest rate world since. And may I stress just what a strange world that is. We're in a zero real interest rate, long-term interest rate world. In every major economy now, real interest rates on long-term government borrowing are round about zero. And they have been for years. That's quite significant. At one period, ours were highly negative. At the moment, I think they're pretty close to zero. And the other two indices I put in, three price industries I've put in, is real house prices. So this is a house price bubble in the fundamental ways. The green line is us, the UK. The blue line is Spain, and the purple line is the US. And you can see that, and I argue it's not really an accident, that we began to get these real prices really rising at about the time, coincident after the real interest rate in the world fell. And that's exactly what theory would suggest. Ben Braunwent, Bank of England Deputy Governor, discusses that link. You'd expect long-term real assets, very long-term real assets, to rise in value when real interest rates fall so much. Along by the change in monetary policy following the collapse of the stock market bubble in the late 1990s. Story. But there was a marked difference between the UK, US, and Spain, and it's an important difference, which is one of the reasons we haven't had quite the same sorts of disasters, but it also makes me a little more nervous. You will notice that in the UK case, actually, if I got this forward to now, we would be about here, there hasn't really been a very big real house price correction. So this seems to have been a permanent shift in the real prices of housing in the UK, and that would fit with the fact that we haven't built anymore. Okay, and that saved us in a sense, except that it means that, of course, young people can't buy any houses in this country because they're unbelievably expensive by historical standards, and then there's nothing there. In the other countries, triggered by this rapid rise in real house prices, there was a tremendous expansion in the land effectively available for building. They then started to overbuild. People didn't realize this was going to be temporary. They were still behaving as if it would be permanent. And the house price overbuilding reached a peak in either 2005 for the US and 2007 for Spain. And then they had huge collapses and lots of losses. So the end game was different because of this different role. So that's the most important thing, because where you have these huge collapses in real house prices, you get huge losses in the people who borrowed and huge losses in the banks. And one of the most interesting statistics, I didn't realize this until quite recently, about 2 years ago, actually, but I mentioned it, is that the UK banks actually succeeded in losing more money in their loans to US households than they did to British ones. That's not, and the biggest losses of all, the RBS losses, seem to have been very heavily in Ireland. So lending into this sort of situation is a nightmare. Lending into this situation is not so bad as long as it doesn't end up like this. So we can't build more houses. This is one of our traps. Let's go on to the next one, and then I'll move on a bit. This is the global imbalances side. Associated with this rise is here. This is one shift which I stress in my book. I would say now I would probably stress it a little bit, but it's very crucial. Huge emergence of surplus savings in three very important regions of the world. The oil exporters, Germany and Japan, dominated by Germany, and Asia, developing Asia, the fastest growing region of the world, became a capital exporter, not a capital importer. That's really weird. I just want to stress the fastest growing part of the world with the best investment opportunities became a huge capital exporter in this period, predominantly but not exclusively China. And those capital were imported net over the balance of payments through the current account by two regions of the world, the US, which was this, and peripheral Europe. We're in peripheral Europe, Ireland, Southern Europe, and Central and Eastern Europe. And what the net importers of capital all had in common, they all put it into basically to housing. The household sectors went crazy borrowing, the financial sectors went crazy lending to them, and they all ended up in crisis without exception. So this is a picture of a huge global capital flow process that blew up. And when it blew up, it started to contract because demand in the world economy went. Let's go on to the next one. This is an important part of this story, which I discuss, which is the role of governments in bringing this about. A very large part of the capital flow from the emerging world, both the oil exporters in East Asia, took the form of accumulations of foreign currency reserves, deliberate insurance against the destruction, in the case of emerging Asia, this isn't true for the oil exporters, against the destruction of their financial systems caused by previous crises. So they decided to accumulate foreign currency reserves, keep their exchange rates low, pursue export-led growth. There was a whole combination of things. And the accumulations of reserves have been staggering, going from under 2 trillion to 12 trillion over a period of 17 years. So $12 trillion of accumulation, and I have left aside the sovereign wealth funds. So that was a big part of this story, and in my view, that was the consequence of the failure of the financial sector to transfer resources to emerging countries before that. And so they responded basically by insuring themselves against it. That meant capital outflows to us, and that had all the consequences I've described. We move on. When there's a huge capital inflow to a country through a huge current account deficit, there has to be somebody in the country doing the borrowing. Basically, it has to be either the private sector or the public sector. Here I focus on the US because it's the most important country of all in this story. And again, I'm sort of look at the picture from 97. There was already a rise, but there was a real acceleration of the rise in debt in the private sector in the US from about 90. This is what happened in the financial sector with its immense internal leverage, innovation, blah, 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 blah. And this is what happened to the household sector, which again, massively increased its debt to levels never seen before. The corporate sector, relatively little. But the aggregate effect was a massive accumulation in debt in the US. We would look just like this, by the way, but I just don't have the time to go through it. And then a deleveraging, and that was associated, of course, with the recession and, of course, the move of the government into deficit. Because once the private sector starts borrowing and starts trying to spend money back, in macro aggregates force through balance the fiscal deficit to explode, and that's what happened to us too. And the final chart here, I just thought I'd put this in to show what happened to the financial sector in part of this process. Is it's one of my favorite charts from the report of the Independent Commission on Banking, of which I was part, and it shows what happened to financial leverage, which is the ratio of total assets of the banks to the amount of equity they have, which is their loss-bearing capacity, prior to the crisis. Just in the first 5 years before the crisis, the financial sector went really crazy. So the leverage in the British banking sector went from here to here in those 5 years. Basically, it more than doubled from about 17 times to about 33 or 34 times. What does it mean when the leverage is 33 or 34 times? It means basically that if the assets of the bank decline in value by 3%, the bank is bust. That's a pretty fragile bank. Okay, that was the picture of the consolidated balance sheet of the 4 largest UK banks before the crisis. And the interesting question, obviously, was how was that allowed to happen? And the answer to that is because they decided that the riskiness of their assets had gone down almost to zero. So this red line shows, measured on this side, the risk-weighted, what's called the risk weights of the bank's portfolios, which is their judgment in the portfolio. And they decided in early 2008, which was just before the biggest financial crisis in history, that the balance sheets of their banks had become almost completely safe. And the reason is they hadn't had a crisis recently. So their models said there wasn't any danger. It was a fantastically irresponsible nonsense. And so the result was, I must say that I only realized this when I worked on the Independent Commission on Banking. As the riskiness went down, they were able to report that they were very, very well capitalized. If you look at the figures on any bank in the world, major bank in the world, in early 2008, they would tell you they were fantastically well capitalized and on a risk-weighted basis. And the reason was they assumed their assets had no risk. That turned out, and that's why this fantastic fragility grew up in the financial sector as part of this leveraging process, which was consequence, in my view, of these macroeconomic drivers I've talked about. Now, when the crisis hit, if we go on, we responded instantaneously when we moved into the zero real interest rate world, into which we are still living, which is why the crisis doesn't begin to be over. None of our policy settings are normal, above all monetary policy settings, and they show no signs of becoming normal in the near future. So this is what happened to the rates of interest. I won't go to the detail. This is the Fed, this is the Bank of England, this is the ECB, and this is the Bank of Japan. And essentially you can see that with incredible speed, we all converge down on the Bank of Japan. And today, the highest rate of interest offered by any of these central banks is by the Bank of England, which is offering the incredibly high rate of 0.5%. Just to put this in historical context, it may not be something some of you know, is that prior to this crisis, the lowest rate of interest the Bank of England has ever had when it used bank rate and then base rate was 2%. So this is a completely new world. The ECB struggled to resist this and has ended up lower than anybody else. Well, it's actually lower than everybody except Japan. And if you think this is an extraordinary situation that cannot last for very long, I put the black line in and went back to 94 just to remind you that Japan has been near zero for 20 years. So we are in an abnormal world, but it wouldn't be abnormal if you were Japanese. We've all ended up being Japan to some degree, not fully. There are important differences. Our inflation rate has been lower, but the monetary policy is the same. If you go on, and the other way in which we've become like Japan is we've all expanded the balance sheets of our central banks. These are the balance sheets over GDP. So the Federal Reserve and the Bank of England have ended up, fascinatingly, purely by accident, at 25% of GDP, the balance sheets, exactly the same. They think they've stopped, we'll see. The ECB cut it down to 20% from 30% and has just committed itself to raising it back up to 30%. So there's an enormous expansion due in the ECB. And the Bank of Japan, which is already near 60, has committed itself to go to 80. So it is basically on that path. Again, these are not pictures that have ever occurred before in peacetime for major states, apart from the German hyperinflation of 23. Which is something else again. So this is an extraordinary picture. Go on. And yet, and this is, I think, the most interesting thing, inflation has remained very low and long-term interest rates have remained very low because people expect these low interest rates to stay forever or very long periods because they don't think inflation is any sort of risk. So Japanese bond yields have gone down to about 0.4%. Germany and France, remember Germany and France have not had large QEs. Germany is down at 0.8%. The French have just broken 1 that wasn't here. French yields are below 1%. The people think they've got a fiscal crisis. Well, I won't go into the nonsense in Britain. And the US and UK are actually close to 2%, which looks terribly high, but in fact is, of course, incredibly low by historical standards. These are Victorian age rates. And the interesting thing is that the US and UK are drifting downwards. And the reason we went up in late 2013 is because everybody thought we were going back to normal, but it doesn't look as though the normal is still going to be very normal. So what I'm trying to say here is that this crisis has left a staggeringly big legacy, not just in output, but also in the monetary conditions and the monetary policy needed to fight it. Despite massive monetary expansion, we've got very little traction on our economies, remarkably little. And let me remind you, yes, the UK has had a recovery, but the UK economy is still almost a fifth smaller than it would have been if the pre-crisis trends had continued. This is quite extraordinary. Let me go on to the next chart. I just wanted to show you, and this I won't take much time over, that the Eurozone has basically gone through a similar sort of process internally to the global one. The difference being within the monetary union, the surplus is with Germany, this is the Netherlands, this is the aggregate balance of the Eurozone, this is the big crisis hit countries dominated by Spain because it's the biggest of them. And essentially the Germans lent, they pursued a real mercantilist policy. The Netherlands ditto. The Spanish and others borrowed in the boom. This blew up. There was a sudden stop in lending. This forced retrenchment. They didn't support fiscal policy very strongly, so the retrenchment was massive. Current account deficits across the Eurozone have disappeared, which is why our current account deficit is so large, by the way. We are the one who are sustaining demand, so that we're an important trading partner for allowing them to do. We are the most important trading partner of the Eurozone. Very important to remember this. So they moved into surplus. The swing in their economies is close to 4% of GDP. It's one of the reasons world demand is so weak. And basically the Eurozone is becoming a big Germany. That's the important point to understand economically, and has very big consequences for us. Move on. And by the way, I just put this in because this is the crisis hit countries. So this is Portugal, Ireland, Italy, and Spain. Their interest rates have all collapsed too. Greece is still very high, but they're all basically about 2% or less now. So everybody has deflation level bonds, yields, even the countries which you used to think as dangerous. And the main reason for that is that the ECB has basically said there's no liquidity risk. Once they took the liquidity risk off the table, they all ended up at this level, as Paul de Grosse suggested they would. And if I can go on to the next one, this is just to compare the Eurozone and US. I'll try and finish in 15 minutes, gives a half an hour for questions. So I just thought I put demand and output for the two biggest affected economies, the Eurozone and the US. So the US has been growing at about 2% a year since the crisis. It's about since the trough of the crisis, which is about in line with its long-term, which is about a percentage point below its long-term performance, but is still positive growth. This is what's happened to real demand in the Eurozone. Recovery, then the crises all hit, and it's still 5% below the pre-crisis peak. And that's because of these gigantic recessions in the peripheral, in the vulnerable countries. GDP is better than real demand because of this improvement in the external balance. So that's the story, incredibly quickly, that I tried to tell in many chapters. Now let me move on to, well, what are the solutions? I'm going to come to this quote in a moment. This is, in fact, I think the last slide. So we have, first of all, what have we done? What have we done? I've already shown what we've done on monetary policy. I don't have the time to go through fiscal policy. I'm very critical, everybody will know this, of the accelerated austerity introduced in 2010. I think that was a big mistake globally and here, but we can discuss that further. But let me just focus on the essence of the new orthodoxy. The new orthodoxy in policy is essentially the old orthodoxy, with the same overall overwhelming reliance on monetary policy, the abandonment of fiscal policy as a stabilizing tool pretty well completely. Interestingly, I should comment here, that's just as true of the Labour Party really as of the Conservative Party. They've given up, even trying to defend the use of fiscal policy as an active stabilizing tool. And that's true worldwide. It's true of left and right across the Western world. We have inflation targeting with the same inflation target. We haven't really asked whether we should be higher or lower. There are good arguments for having a higher target, I think. We have done no large-scale debt restructuring, so we basically preserved the debt that came out of the crisis, except to the extent the private sector just went through bankruptcy. We've abandoned coordination with fiscal policy after the first couple of years. So it's been very, very conservative. If we look at the financial system itself, we have tightened regulation. We now hope that we will be able to deal with banks without injecting public money by resolving them. That means turning debt into equity in a crisis. I think it's almost certainly not going to work. We have introduced fantastically complicated and tortuous regulation. We have an even more concentrated banking sector than before. It's still massively leveraged, though less leveraged than it was before, and it still relies on this absurd risk weighting of assets, and I've already told you how dangerous that is. And of course, it's still global and therefore incredibly difficult to regulate. So what is surprising in a way is just how conservative the response has been to this massive crisis. And I put this quote up here because I think it's so remarkable, just to indicate, in my view, how unworkable it's going to be. And this is from Andy Haldane and a colleague of his at the Bank of England, a paper they delivered at Jackson Hole a couple of years ago. And they were just talking about Dodd-Frank. And what they've said is, as of 2 years ago, the Dodd-Frank had added about 9,000 pages to the US regulatory rule book. And at the end, it will be 30,000 pages. And that's 1,000 times larger than Glass-Steagall, which actually was an effective regulatory tool. And in the case of the Europeans, it looks as though the pages of regulation will be about 60,000. And if anybody thinks that you can regulate an industry on that basis, I think they're completely fooling themselves. You cannot operate that. Nobody in the regulated institutions will understand these rules. They will have compliance officers everywhere who will themselves make mistakes. They're going to make mistakes all the time, so no doubt there will be many, many fines, but it's almost inevitable. And it's a result of the fact that we've basically decided to leave the bank financial system exactly as it was, but we don't trust it. And that leads you to the worst of both worlds. You have the same financial system because you don't trust it. You want to micromanage it. That, I think, is a really big problem. I discussed that in the book. The big key to solving all these problems is what's called macroprudential policy, which is we already have operating here with Financial Policy Committee, and it's a big and important regulatory change, but it's going to be very difficult to make that policy system work. I don't have the time to discuss in detail, but the interventions will be very difficult to judge. Often they're going to basically prevent people from borrowing to buy houses, which is politically sensitive. They're going to be very politically unpopular, and there will be pushback. And more, as important, they're likely to conflict with monetary policy. Because there will be times when you're trying to stop credit expanding with one hand. That's what the Financial Policy Committee will do. We'll be trying to stop credit expanding. Well, the Monetary Policy Committee has decided that's what it wants to happen because it wants the economy to expand. And nobody knows quite how that will work because nobody knows through what channels it will work. The most likely one is through the exchange rate, and that means we're all going to be pursuing beggar my neighbor policy. And that's going to create some real problems. So I regard what we've done on the finance as a modest improvement, but we still have a fantastically unstable system in its essence, combined with incredibly complicated regulation. Nobody knows, and nobody knows how this will work, and nobody can really believe it will work. And the second big area, which is obviously a concern, is demand. As I've already indicated, when you look at the performance of our economies, is that with the exception of the UK, at least, which has been growing, though if not in GDP per head, at about pre-crisis rates for 6 or 7 quarters, nobody has managed to get to pre-crisis growth in demand, never mind the levels. So we've simply generated an inadequate recovery. And as a result, we have huge losses in economic welfare, which appear to be permanent. And losses in GDP go with losses in real wages, by definition, and losses in employment, and the combination depends on different economies' reaction to the post-crisis situation. The losses have been so large for 4 reasons. To a certain degree, I think a modest degree, but to a certain degree, pre-crisis trends were unsustainable. The crisis itself damaged the economy and was allowed to damage the economy. It bequeathed a big debt overhang, which many economies didn't deal with well, and policymakers adopted some very bad post-crisis policies, and the most egregious case was the Eurozone with its imbalanced austerity program. We need stronger demand. We should have started a much bigger public investment program back in 2010-11, because it was completely obvious to anybody that this situation was going to last for many, many years. Therefore, it would be perfectly safe to have a large public investment program. The government was able to borrow more cheaply than ever before. And this obsession with the debt stock without considering the cost of borrowing is just crazy. How much it costs to borrow is crucial in deciding whether you can afford more debt. And there should have been better cooperation between monetary and fiscal policy, including direct monetary financing of the government, in order to expand the money supply adequately. It would have been perfectly straightforward to do that. The biggest demand problems are in the Eurozone. What I call the Greater German strategy cannot work. It's ultimately impossible for the Eurozone to grow on the basis of external net exports. The Eurozone needs massive internal adjustment and competitiveness, and that can't happen if Germany doesn't have inflation substantially above 2%, and there's no chance of that happening. So adjustment in the Eurozone is unbelievably painful. It's forcing the vulnerable countries into deflation, and therefore their real debt levels are continuing to rise, and that probably means a return of the debt crisis in the Eurozone at some point unknown. In the long run, I think we're going to have to think of different solutions for demand. One element of this, which I stress, is better insurance for developing country fiscal deficit, current account deficits. And that I argue that we need a much bigger IMF. The IMF is now much smaller than was planned even in the 40s relative to the world economy. And with open capital accounts, it needs to be much bigger. I suspect the IMF is really about a quarter or a fifth as big as it ought to be to give adequate insurance for developing countries. And that's why they've accumulated this massive quantity, very costly reserves. Domestically, we need some combination of more capital in banks, deleveraging of our economies through changes in the treatment of debt. We need more equity contracts, particularly in home purchase. I think we should be much more radical. There's a very good book by Atif Mian and Amir Sufi on the US finances, which emphasize the possibility of equity sharing contracts. And as I've already indicated, I'm very sympathetic to the idea of using state-created money as part or whole, or part at least, of our monetary system. So my conclusion, very simple in the book. It's a major disaster, and an ongoing disaster. It was caused by the interaction between macroeconomic shifts and financial fragility. I haven't been able to discuss all of them, but at least I've discussed some of them. I think the orthodoxy we have today, the new orthodoxy, is more realistic than the old one, but it's very likely to fail again. We haven't made big enough changes. We need to make our macroeconomic system more balanced globally and internally, and we need to make finance far less fragile. And of course, that's just for the long term. In the meantime, it looks as though the shadow of this crisis will remain over us in the Western world for the indefinite future. I'm not saying forever, but it's clearly going to be with us till the end of this decade at least. Thank you for listening.
Thank you, Martin. I'm going to start off with a couple of questions, and then let's have an audience discussion. My first question, Martin, is this question of savings glut. Opportunities. That's my first question. And then the second question is the relationship between fiscal policy and monetary policy and the pressure on monetary policy constantly to do more. And we've seen where that goes with the Bank of Japan. Your chart shows us where the balance sheet goes. But it's not just the size of the balance sheet, it's what they're doing with the balance sheet. Converting debt to equity, for example, is a completely new step change in the way in which central banks are being treated. But my concern is that really this quantity approach to monetary policy at the zero bound is actually inherently promoting inequality, and that there is a very important inequality narrative which is undermining the sort of legitimacy of government and politics, a political economy point about central banking. Can I start with those two?
My God. Okay. On the first one, I think this is right. And the answer to your question is actually, is it a savings glut or an investment dearth? It depends, in the sense that a lot of changes occurred around the world. which cumulatively had the effect, I think, of shifting propensities to save vis-a-vis propensities to invest. Of course, at the world level, they are equal. So the only way you can really measure it at the world level would be by its price, and that's why I think the real interest rate is so relevant. By the way, at the aggregate world level, savings investment remained rather similar, though their composition changed. Basically, my reading of the evidence is that in the developed world, by and large, both things happened. That is to say, propensities to save rose and propensities to invest fell. And the most visible sign of this after 2000 was the emergence in most Western countries of big Western countries of very large financial surpluses in the corporate sector, non-financial corporate sector, which meant essentially, to put it round, that their retained earnings, the profits they retained, exceeded their investment. And that meant, by definition, they were acquiring claims on other sectors in the economy. And once you worked through it, it meant actually, since they put the excess mainly in banks, a lot of it in the repo market, by the way. That's a large part of what this repo market was. It's what corporate treasurers put this money in, and it ended up either with households or with governments. So we had this very weird situation in the Western world, particularly in the US, also the UK, Germany, that the non-financial corporate sector, which you think exists to invest and use resources from the rest of the economy, was actually providing them. They became the banks in some way. That's got even worse since the crisis, by the way. And that was the result of both shifts towards savings in a way. The household sector has by and large saved less. So it's, but in aggregate, that the reason that the household sector then went into massive financial deficit in the US, UK, a few other economies was that they saved somewhat less, and of course lots more houses were built which they bought, and that's always attributed to the household sector. That's that part of investment, and that turned out to be a temporary bubble. That's how we fixed it. In the emerging countries, it actually went in diametrically opposite directions. The most important country by far, China, had both a huge investment boom and an even bigger savings boom. So China went into a place which has never been seen before in history, in a completely unique configuration, in which the economy was investing about 42% of GDP, already the highest of any major economy in world history, and it was saving about 50% of GDP. And so it was exporting at its peak about 8% of GDP, 10% of GDP actually at its peak, as surplus savings. So it was both more investment, more saving. The other crisis hit emerging Asian countries actually went in the opposite direction. So it's a complex range of events, and the net effect was to unambiguously, it seems to me, shown both in the real interest rates and in the way, as I said, in asset prices and in imbalances, a massive flow of surplus savings, which ended up in the household sectors. And when that blew up, it ended up in the governments. This is very important because it's relevant to a point that I will stress about British fiscal position, since Gavin Davis raised it in his wonderful and excellent column today, which is the question of how on earth will the government manage to get back to a fiscal balance if we continue to run a current account deficit of about 4 or 5% of GDP? And that's increased, and all the signs are that as our economy recovers, that will get worse, not better, partly because of the Eurozone problem. And the answer to this is just an analytical, simple, logical point. This combination is only possible if the private sector goes into a financial deficit of about 5% of GDP. And how that is supposed to happen, the government has never answered. But essentially, it requires either the most monstrous investment boom in housing, very unlikely, or a massive investment boom in the corporate sector, virtually inconceivable, or a collapse in profits. There's really nothing else left. And any of these possibilities are very unlikely, which is why the government's fiscal plans cannot be delivered under the current structure. and they're not going to happen. I think they're just not going to happen. That actually links to the second point, which is how you use the monetary instrument at the zero bout. My own view is that we exaggerate the role of monetary policy in what's happened to asset prices since the crisis. And we certainly exaggerate the role of QE. Now, this is a really big and controversial issue, and we don't know. Let me be clear. But my view is twofold. One, the most important driver of what's been going on in markets is the perception that short rates will remain very low for a very long time. And if people expect short rates to be low for a very, very long time, they know that the returns on financial assets will be very low, and long bond rate yields will tend to converge on this. And let's just say long bond yields will be very low. And if safe long bonds are yielding 2% nominal and 0 real before tax, so negative if you pay any tax, you have to buy something else if you want any real return. And that's what's happened. So I think the search for yield and the asset bubbles, all of the things which have driven wealth divergence in the way you describe, are largely a function of the monetary policy environment broadly defined. The evidence we have is that QE, after that is to say the pure expansion of the balance sheet, though they felt they had to do it, after 2008-9 had a relatively modest effect, not zero, but at the most they lowered yields by maybe a percentage point. But they already were, and that's the most. I did one long piece for the FT looking at the literature on this, and it all varies between 0 and 1%. So it's not more than that. So it's the low interest rate environment. But then you have to ask yourself, is the low interest environment just a function of monetary policy? And my view, of course, is not. That there are real forces driving real interest rates down to 0. And the real forces are, put it bluntly, we're in a slump. We're in slump conditions. Slump conditions are ones create strange effects on asset prices, strangely enough. That is to say, if real interest rates are low enough, even if asset prices have to rise to the point that the expected real returns on these assets fall a lot. That's just the basic theory of this. So you get these huge asset price bubbles, which then mean whatever you buy is going to have a lousy return, which is a very important point about where we are now. So what does that mean? Well, it means, in my view, as I've been arguing, or trying to, perhaps not as clearly as I should have, and Adair Turner has also been arguing, I find it very strange that Adair and I should be so much more radical than any politician. But essentially, the monetary policy instrument should be combined with fiscal policy, because the tool to generate demand, as Keynes pointed out, when the private sector does not wish to spend its income, is the public sector. The public sector can spend in these circumstances because it's not debt constrained, and when it can borrow at the lowest real interest rates in its entire history, that's pretty obvious. But if you're really worried about this, it can borrow from the central bank and print money. But since monetary growth is so low, even if you're a monetarist, and I'm not, but even if you are, you would be quite relaxed because monetary growth has been incredibly low in all these economies now for many years. So I think the less regressive way of resolving the problem would have been fiscal policy, and if necessary, fiscal policy augmented by monetary policy. So I think we got the mix wrong. I've been arguing this consistently. I'm regarded as a complete lunatic, the last Keynesian, as it were, but I'm absolutely sure it's what Keynes would have argued in this situation. And he would have said, when the British government can borrow at 2% nominal and 0 real, and we have large infrastructure and investment needs and large public needs, it should spend the money and relax about the deficit. But it's not what's happened. But I would focus not on monetary policy from a technical point of view, was it QE or interest rates? I think they had to do that. Given the fiscal policy, they had to do that. The mistake was given the fiscal policy. Essentially, we continued after the crisis, except for 2008-9, just for those 2 years, we continued with the old orthodoxy that all macro policy should be done through the Bank of England. Given that, I think the Bank of England and the other central banks did the right thing. But that fundamental decision was, in my view, a mistake. And I hope that future economists, when they come back to this experience, will conclude it was a mistake. But at the moment, we're very much, our view is very, very much in a minority, as you can see, and the more or less complete consent of everybody that the most important thing for the government to do in the next parliamentary term is to cut the deficit.
Let's take some questions.
There are two questions. That's all right. First is the implicit in all of your kind of critique is that there was a failing of economists to understand the economy pre-crisis or the way the economy is working. And I wondered what your opinion was of why we haven't had a paradigm shift in economic thinking, really. And the second question is, post-crisis, what seems to have happened is a big shift in power or responsibility for the running the economy to the central bank, even more so, both kind of explicit in terms of the FSA, but also implicit in terms of the fact that there was no fiscal policy and all of the responsibility for growth was given over to the central bank. And I wondered what your view on how sensible that is and how well the bank is able to equip itself to do that moving on.
These are two really fascinating and very, very important questions, which, since you're much younger than I am, you can resolve, you'll have time to resolve. I think the resistance of economists to the change of the paradigm probably has two or three elements. First, it wasn't the Great Depression. Okay? So it could have been, in my view, but it wasn't, because we've, in the 2 years, crucial years of 2008, 2009, the sort of toolbox box of the 30s was taken out and they used it. And the view that we could stop something like a Great Depression, even if the economy started to collapse, was proved to be true. So we tested that. Ben Bernanke, who started it first, really it's a monetary policy maker, but all the fiscal policy makers did too. They jumped into these huge deficits. There was some expansion as well. They accepted the deficits for those first couple of years. And because there wasn't a huge disaster, it sort of, there was a disaster, but not the Great Depression scale. Economists weren't forced to reconsider. And the second point, and here I have to be absolutely fair, and I don't want to be simplistic about it. Doing macroeconomics where the financial sector counts is really hard. And we don't really know how to do it that rigorously. We have some very, very profound insights we dropped. What I think of as the Wicksell-Tominski strand, when they were dropped because they're just so hard. And since economics nowadays, and this is the third reason, insists on extremely high levels of analytical rigor of a mathematical kind, plus in the monetary policy making, all these quantitative models, they just didn't know how to do this. They still don't know how to do this. And I probably, like many scientists, I don't know enough about other scientists. I'm claiming they're scientists. Okay, let's forget. Other intellectuals have assumed that if something is impossible, it can't be important. It seems reasonable to me. You know, it's the way human beings face most problems. If it's impossible, it can't be important. So the answer is, I think, because it's possible, it can't be important. So you don't do it. And I think that's the analytical thing. The great thing that Keynes did, and why the General Theory is the most important book in macroeconomics ever written, is not because it was perfect, but because it was a set of answers. It was a coherent theory. It had problems. Well, we know it was, but it was a coherent theory, and therefore it was. You didn't need to say, well, what we're doing is all wrong. We must do something else. Keynes said there was something else. Nobody has been clever enough to do an updated Keynes, if you like. What's clearly what is needed, which fully integrates his insights with the insights about finance. And my book is good enough to explain why we need to do it, aspects of it, but I don't begin to be brilliant enough to do this. Nobody else is. I mean, nobody else is. So there's your generation. The second thing was fiscal monetary.
It was the kind of increased responsibility.
Yeah, the central bank. Well, if you operate in a world where you rule out fiscal policy, and you're frightened of using fiscal policy because it will lead instantaneously to default and the end of become Greece and other such utter absurdities. By the way, there's a lot. I didn't expect the crisis on this scale, but I sure as hell got this right. So it wasn't very difficult to see we weren't going to become Greece. Fantastic stupidity. So they decided they must have fiscal tightening. And this obviously served a great political purpose in this country, though other countries did it, so it can't be the only explanation. But obviously in this country, if you emphasize the need for fiscal tightening, it allows you to explain that it was the fiscal processes that blew up the world rather than the financial crisis, which you were just as guilty of because you also believed in financial liberalization. But that's a political issue. Once you rule fiscal policy out, and for various different reasons, it was ruled out in all the major countries. In the US, it was ruled out because the Republicans were nuts and they had enough power to stop the president. The president's administration were perfectly rational. They realized very early that the first stimulus wasn't big enough. They should have realized it day one, but that doesn't matter. They wanted more and they could never get it. It was just impossible. So the US was blocked by US parties. In the Eurozone, it was blocked by Germany. And how, and I think Germany's views on this are just completely Neanderthal. And in Britain, it was blocked by the politics I've described. So you're left with the central bank. And everybody seems to be remarkably comfortable with handing over immense powers, I mean, truly immense powers to a completely undemocratic institution. Now, I have no problem with giving the central bank responsibility for monetary targeting. But if you look at the Bank of England today, it is responsible for managing and regulating the entire financial system, which is the most important part of the private ordinary people. It is responsible for essentially for deciding the price at which you borrow, how much you can borrow, and for what, through which institutions and how they are allowed to behave. Admittedly, the conduct authority does part of it, but it really is. And then, in addition to that, it controls the cost of borrowing. It controls the whole of monetary policy. So all discretionary policy has been handed over to. And interestingly, Keynes, who really did believe in the Mandarins, might even have approved of this because this is the ultimate Mandarin institution, and it's certainly much more intelligently run than under Montague Norman. So it's an improvement in that. Technically competent, lots of very, very bright people engaged, and obviously I know most of them, but I think I know all of them. But its powers are ultimately limited to monetary policy. It can't coordinate with fiscal policy, which is a very big deal in this situation. And its mandate is pushed to the absolute limit of democratic competence. Again, I'm very, very surprised. Nobody in politics, well, perhaps a few on the Labour left, I don't know, has raised the question of this staggering concentration of power in this institution. And I was against it, not strongly, because I thought once you've given up fiscal policy, you've got to have somebody who can act. You can't lock up everybody. I mean, the Eurozone has tried to lock up everything, and look where that's got to them. But it's a very, very big and profound issues, and I hope when when people start reanimated and started thinking again instead of this incredibly depressing period we're going through, they will start asking that question.
More questions?
Yeah.
There's a mic, I think.
Could you just share an affiliation, if you would?
Affiliation?
If you have one.
Which type? Yeah, I'm actually working in the city on the insurance side, not the
Okay.
banking side, but familiar with risk models and the ilk. Actually, just trying to get one past the regulator right now. It's a very simple question, but forgive me if I'm not. It's not my field, the economics and the macro stuff. But you mentioned Germany and the euro. But if you look at the political spectrum, I see in the news today that the National Front in France, we see that there's an Italian body that are polling at 25-30% to leave the EU or the Eurozone, I'm not sure which. And obviously we have UKIP in this country. And we've had the experience of the Scottish referendum where people were talking about separating. And he would have won if an option to join the euro had been on the cards. But because he couldn't use the euro as a currency, he had to talk about what was going on with sterling. But the point is, your opening line was something around the fact that the policy think tanks, the policy establishment had completely failed to address what went wrong and therefore could not come up with solutions. My point is that the centre left, forgetting Germany, but the centre left across France, Italy and the UK, surely in response to the isolationist vote building, they surely have the pressure, even if there's a kind of solution and we're trundling along at the moment, surely they must look to the kind of ideas that you've articulated today, which say, if money is cheap, you need to invest in jobs for people so that they can live and not worry about immigration or worry about other people running their lives. Because this is, to me, it's a failure of social democracy at the moment.
Well, I'm very sympathetic to your view. I don't think I'm writing a political book, but the last few pages of my book basically say the following, that democratic societies, and it's true of them all, there's sort of a compact between, if you can call it that, broadly speaking, the policy elite, the elites, we know who they are, we can discuss that, and the mass of voters. Society, economies are complicated, very complicated, and we accept, perhaps rightly or wrongly, but I think rightly, a large amount of delegated authority. So to central banks, to governments, and of course to private businesses, major private businesses like banks, which clearly have a social function as well as a business function. And the elite failed to deliver their side of the compact. Essentially, the mass of the population says, not formally, but we will trust you to do this on our behalf in return for your ensuring that we have a reasonably stable economy, and our hope for improvements in our welfare, economic welfare of us, our family, the people we care about, will be delivered. We will have jobs and all the rest of it. That's the deal. That's what I call the deal. And we can discuss the elements in the deal, but I think that's the essence of the deal in a modern democracy. If the elites fail and are seen to fail, then the people will quite naturally notice, because they will, because it will affect them directly, and my God, it has, and they will start saying, well, these guys are hopeless, let's listen to somebody else. And we've been through this play before. It's what happened in the 30s. We know how it ended, which is one of the reasons why I was so desperately concerned, and I wrote this very explicitly in late 2008, that the response, whatever the reason for the crisis, the response had to be overwhelming, so that we got out of it as quickly as we possibly could. And I discussed many of the things that had to be done. And in the first year or two, I think they didn't do too badly. I would have done more. Then they went crazy. But you got to get out of it because it's your job. Now, as it is, we prevented utter meltdown, so we didn't have the early 30s. In addition, the welfare state, of course, is obviously a much better cushion than what was available in the 30s, which is essentially nothing. So the political consequences didn't include Adolf Hitler or equivalent. Okay, that's the most extreme example. But of course, in the 30s, there were many other. France fell into something pretty close to a civil war before the 30s. In the UK, we also had a big, the black shirts were not insignificant, but nothing like that significant. Unfortunately, we went off gold and started pursuing relatively sensible policies, and being part of the being the head of the imperial system allowed us to do that. And we had a reasonable recovery in the 30s. Not perfect. Unemployment remained very high, but it was a reasonable recovery. It was not as bad. And I think that's one of the reasons why we remained relatively stable. And then in America, of course, thank God they had FDR. Who knows what would have happened if they hadn't had FDR? I mean, it could have. There were lots of fascists around. If you think about the famous Huey Long and others. So the dangers are very great. And I think we're seeing the same thing now. It's not on that nature because our countries are more comfortable, better cushioned and so forth. But clearly the failure of the elites is having profound political consequences. And I think it's going to get worse. These things take a long time. People first realize something terrible has happened. Then they realize it's not going to get better soon. And then they realize these guys we're voting for haven't a clue what to do. Their ideas are stupid. It's obvious their ideas are stupid. I mean, the debate we're having about economic policy in the run-up to this election is a scandal, a complete scandal. It's irrelevant to anything that matters. I've completely failed to persuade anyone of this, but it's my view. We don't discuss the productivity collapse. We don't discuss obviously the real wages problem that goes, the inequality problem. When we discuss the public finances, when it's the last problem we have, right? The least important problem we have is the public finances when the government can borrow at zero real. And by the way, as I've pointed out a million times, our net public debt is way below its historic average. And France and Italy and so forth, it's much worse because it's being imposed from outside. It's completely undemocratic. The French are going to get a fine probably from Brussels for doing the sensible thing. The people are going to blow up. So my guess is the Eurozone will end up with a monstrous political crisis before the end of this decade. I have no idea what form it will take, but I would guess it would be one or more, perhaps many major countries. Renzi will be the last gasp for Italian Orthodox social democracy. He's a decent fellow, hasn't got the slightest chance of success. And because he will fail, the next thing will be worse. And they will have destroyed the hope. And he knows this, I've met him, and he knows very well what's at stake, but he won't get the room for maneuver. I think Mario Draghi, finally, relying on the one man who can do something, has finally got this in his teeth and realizes the threat. So the answer to this is complete failure. And if I may say so, since you're much closer to them than I am, well, that's not really true. But anyway, the Labour Party is a catastrophe intellectually. I mean, I'm just completely irrelevant to any of these stuff. And I find it astonishing because neither of the Eds is stupid. I think they're just intimidated by conventional wisdom. So they think they might well be in government. They could well be in government. What the hell they're going to do, I don't know. But it will discredit them. That's the real problem. They'll come into power with a program that won't fix it at all. And they'll be discredited. That seems to me a disaster. It frightens me. So that's how I end. So I agree with you. I do think we could have even better ideas on the right. Some people on the right are actually not crazy. Ken Rogoff, for example, who's a relatively conservative, says, well, let's restructure all the debt. Well, that would be something. That would make a difference. In some of these countries, it make a big difference. Spain, for example. So, yeah, scary. I have nothing more to say, and I think it's a long burning thing. Unless we start getting real recoveries with real income growth, maybe in the UK we will. I doubt it for the reasons I've given. So, next question.
You have time for one more.
And my answers are long, but these are very deep questions.
Yeah.
My name is Rodothier from Policy Network. I'm struck by the fact that basically the policy solutions you recommend are only based on the demand side measures, and you don't talk at all about structural problems and the fact that actually different countries might have different abilities to create growth. I mean, especially European economies, when you think about the changing demography and the fact that we live today in an open economy, so you need a slightly different growth model than the one we used to have maybe in the 70s or before. So that's why, I mean, when I hear that France and Italy and so on should spend more, I say, yeah, of course, but at the same time, I mean, we need to consider that at European level, but at the same time, there are some maybe structural changes to be made. So
Yeah, I don't disagree with that. It's discussed in the book only in passing because it's basically, my perception is like most huge depressions, there's a demand side phenomena. There was very little sign 6 years ago that the aggregate output of the Eurozone was under serious excess demand. Eurozone in aggregate had a balance, and different economies were in different positions, and there was no inflationary pressure. Today, 7 years later, despite net investment, not much, but net investment, real output is substantially lower and real demand is 5% lower. It's really hard for me, and inflation is slowly creeping down to zero. It's really hard for me to see this in aggregate as an economy suffering from deficient supply. Now, of course, it is true that there are very severe competitiveness imbalances within the Eurozone. The main reason for that is that Germany pursued a real wage deflation policy for 10 years, and that completely unbalanced competitiveness within the Eurozone, such that if the remaining countries are to have demand that exhausts their supply, they will tend to run very large current account deficits. That's the truth. So there is a tremendous internal adjustment problem. And since there isn't financing possible, that adjustment problem has to be resolved by major changes in real exchange rates within the Eurozone. The only alternative way of doing it is by running I'll come to your structural thing, in a gigantic surplus, which I don't think is going to be manageable. So these are perfectly standard adjustment problems within standard macro models. I don't think there's anything very exciting or different. It is also true that in a number of economies, underlying trend growth and underlying trend employment trends are very, very poor. They were before the crisis. There's no question about that. The biggest problems, unquestionably, were those of Italy. Italy hasn't had any productivity growth, as far as we can see, really for about 15 years, and unemployment has been quite structurally high. So clearly the structural problems of Italy are massive. There's no doubt about that. Whether they required real demand to contract by 10% is another matter, which is what happened. But there's no doubt there are massive and Italy won't get back to growth, real growth, without pretty major structural reforms. And I think Renzi understands that. But if in the current situation he introduces these structural reforms without any demand support, he's going to end up with unemployment over 20%, and it's going to blow up. Just a statement of fact, it's going to blow up. The Italians are weary of this. So you have to decide the political risks. France has an overvalued real exchange rate vis-a-vis Germany. It's not at all clear it has an overvalued real exchange rate overall. I think we can argue, I'm personally prepared to accept that French public spending is excessive. It's certainly incredibly, unbelievably high. So I wouldn't recommend Britain goes to those levels. So I would agree it should be cut. And the labour market is a real problem in France. There's absolutely no doubt about that. But none of that, productivity growth is quite reasonable, and productivity levels are fantastic. Only ours were as high. I think the weaknesses of the French economy, perhaps because the French do such a good job of complaining about it, are much exaggerated. Basically, the US and UK and France are quite similar. But yes, there are structural changes that are needed there. Spain has some big structural challenges that they've done with a lot, and Greece is, of course, is somewhere else completely. I mean, Greece is essentially a developing country still, and it should be seen as such. It never became a developed country. It was only able to afford this standard of living because of this insane lending to Greece, and of course, which supported the Papandreou Papandreou, and then was it the prime minister, the Conservative prime minister? Anyway, that completely respond. So Greece and Portugal is also a development problem. I can go through all the economies. Ireland is straight overheating, absolutely clear. Financial sector overheating, no structural problems at all, in my view. It was an absolutely straight housing boom, which should never have been allowed to happen, and there was a lot of corruption there. So they're all different. And I accept they all need, we can discuss it, lots of different policy changes. Germany needs structural changes to allow people to go and shop. And the corporate sector is underinvesting, which is a very interesting question. Why is that happening? But it's still the case, you have to treat the Eurozone as like the US. It's a economy now. That's what it means to be a monetary union. And even if you assume trend growth is only 1%, and that means nominal GDP should be rising if you've got decent macro policy at about 3% a year. As I said, and that's assuming that trend productivity growth is only 1% a year. That's not much, but it's still continuing. So can the Eurozone, it's got a better external balance, the US. Can the Eurozone outputs expand nominally by 3% and real 1% from current levels? Of course they can. I mean, they're incredibly depressed. That would only bring them back to the pre-crisis levels and 10 years after the crisis. So my view is, yes, supply policy is important. It has to be finally judged, but the Eurozone has a clear demand problem. It is a significant demand problem. And what's more, in practice, I know the Germans think people will only do supply reform when they're in the last stage before total and utter collapse. My view is that's a fantastically politically dangerous strategy, and a more sensible policy would be to try and combine the two. But that's a political judgment ultimately, and it is irrelevant because my policy won't be tried. The German policy is being tried, and we'll see how it plays out. I think that if it weren't that the costs of breaking up the Eurozone are so astronomical, and they are, truly astronomical, unbelievable, what the consequence would be, it would have gone already. And political leaders privately, and obviously in my position I do, they're desperate. I mean, really desperate about where they find themselves. And I'm talking about France and Italy. And if the crisis gets to be really significant politically in these two countries, which surely looks quite likely, then all bets are off. We're not talking about small countries. We're talking about if France, Italy, and Germany can't work together, you've had it. You've just had it. The system blows up. And I'm concerned that's where we are headed in an election which looks like, to me in France, to leave us either with Marine Le Pen or Sarkozy elected on an ultra-right Marine Le Penish platform. Now, the only good thing about Sarkozy is he changes his mind so easily. So he might do so within a day, but it will be a very dangerous situation. And after Renzi in Italy, there is nothing. Nobody has the faintest idea what will happen in Italy if Renzi fails. So it really is worrying. And I said, I insist on demand. This is what I insist on demand. Europe keeps on insisting its supply, and I think that's only about a third of the truth.
Well, that's about as withering of the current policy framework as I think we could wish for, Martin. Thank you. And I hope everybody who is involved in policy formation, thought, writing, thinking will go away and think about it a lot more. I will. So thank you for your time, and I think you're going to sign some books.
If anybody wants to buy them, I'm happy to sign.
Thank you.
Very depressing.